Good morning. I'm Malcolm Grahamwood, and I'm here on my corporate finance duty with my usual C-suite interview. My guest today is Andrew Austin, Executive Chairman of Kistos. Good morning, Andrew. Great to see you again.
And always a pleasure to see you, Malcy.
Brilliant. Well, it's been a little while, and for various reasons. So, if you could just give the viewers a quick overview as to what might have changed since they last watched, just in highlights terms.
Well, I think we've moved on in terms of obviously the tax position in the UK has been changing. We've got news around the status of Norway and how quickly Norway will be brought on stream, and we can talk about that. We've also made the acquisition of the gas storage business in the UK, which I think is very exciting. It might not be upstream style returns, but it certainly is a very interesting business to be involved in, and I think it's one that we bought at a bargain price, which at the moment is quite difficult to do in other upstream deals.
Great. Well, that's where I would like to go first, to be honest, because I've been getting more excited about this gas storage, the assets that you bought. So maybe
we like it when you get excited, Malcy. Good position.
So do I, and we need it a bit in this market, Andrew, to get people excited about shares. Yeah, tell us what you bought, how much you bought, how much you paid for it. How does it fit into the portfolio? You've talked to me before about there's lots of upside in terms of, operationally and capacity and so on. So far away.
So we bought it from EDF Energy. Basically, it had become non-core for EDF. So EDF's activity in the UK is now generally focused around their nuclear ambitions, which is, obviously very, very public and everyone knows about that. So it become non-core for them. It's a very, very well-maintained asset. I mean, I've run some onshore assets in the UK, as a lot of people listening to this will know in the past. And I've never gone around such a smart, well-maintained site in my life, and I was responsible for quite a lot of them. So on that basis, it's a good place to be. I think from an EDF perspective, they looked at it as not only being non-core, but also that, if there was ever an issue at that site, it could actually, which we bought for 25 million, it could jeopardize their position on their nuclear ambitions, and that, that's 25 billion. So for that reason, you can understand why they would, invest of it. The price we bought it at is effectively less than the value of the cushion gas. So if we decided tomorrow that we were going to dispose of it, we could make more money than we actually paid for it in the first place. In terms of its expansion position, we've already increased production, the storage capacity by 24% since we bought it by doing a soft cycling test. And because of this risk-averse position, which I completely understand from EDF's perspective, they weren't prepared to do. And so we've done that. That's already increased it. We also have the second site, which could put it up by another probably 80%. And we're running a feed study right now on the costs of doing that. Now, because these are salt caverns, you have brining and cushion gas issues, but we feel we've worked out a way that we can actually bring the second site online using the existing brine and cushion gas that's there, and get that into where we stand. The other thing that's going on is we have a trading partner which we're working with on this, and we have three lines of revenue really. We have the the intrinsic position, which is effectively a summer-winter position, which we locked in at 22 pence a therm. We then have an arrangement with the national grid where they pay us to retain an amount of gas in the store just in case the grid needs it. And then thirdly, you have what's called the extrinsic trading position, which is the sort of daily trading. And we've traded way more volumes than, I think, in the first 3 months we owned it, we traded more volumes in and out than EDF had done in the previous 9 months. So we're trading it quite hard. Our our issue is electricity prices, because we have to. So when the gas goes into the store, it goes in straight off the grid because it's at pressure and it's fine. When it goes out, we have to pump it out, and so we have to watch what the electricity position on that is. But again, we're working with our trading partner and trying to optimize that position. But we're already making significant revenues from the business. And actually the morale and everything at site is really, really strong because everyone goes, hey, we sat here and waited for EDF to do things and they never got around to doing anything. And now suddenly you guys have come in as owners and, you're active, you're doing stuff, you're making it work. So, so it's very, very positive. So already increased it by 24%. We'll increase it by probably another 60-70% over the next year, 18 months. We will be one of the largest, onshore storage facilities in the UK. Rough is probably going to close down over the next couple of years. It was brought on during the energy crisis when Ukraine was invaded, because it had been mothballed by Centrica at that point, and you know this story, Malcy. Anyway.
Yeah.
But long term, Rough's not in a good place to do these things. So I think it's going to be increasingly important. And I have to say, when you walk around the site, and I'll take you up there one day, because you've never struck me as someone that I can take offshore to one of our offshore sites. So maybe I have to take you to one of our onshore sites, Malcy.
I've been to plenty of offshore sites, but nowadays I'm a little less able to get into those fancy seats on the helicopter.
It's not going to set the world alight in terms of its returns, but remember, it's outside the ring fence, so you're being taxed at standard corporation tax rates, which is a very different position. It gives us a flexibility so that if in the event that gas prices drop, we can just fill our own storage and then sit and wait.
Yeah.
And those kind of options are there. But at the moment, the trading we're doing with it is just spread trading by time. So you buy September, you sell January, and you lock in a profit. So while it's ostensibly a trading business, it's a trading business with a locked-in profit margin.
Okay, so are these traders your own, or as you say, arm's length, or are they using a firm or any?
Yeah, I'm not at liberty to say who it is, unfortunately. It's under the terms of, but they are probably some best gas traders in Europe. We have a 70-30 profit split with them, where we take 70% of the profit on the extrinsic trades. We take 100% of the profit on the intrinsic trades. They're very excited about it. They actually wanted to buy the asset themselves, but their parent company wouldn't let them do it because it was an operated business.
Yeah.
And they actually offered more money than we did. So I think that's quite a positive reference on where we stand.
Okay, so you addressed the fact there is still upside in the capacity for what you've
Very
got.
considerable upside. And
and
we've already realised some of it.
and you're outside the tax regime. Any other deals around in this space?
No, yeah, I think we should focus on trying to get this right and take the value out of putting the next part of the farm in play. Once we've done that, we can look at other things. But these are certainly assets that are becoming more valuable in the way in which people are looking at them.
Yeah. Right.
Changes conversation with government as well, because if you go in to speak to government now and you say, well, yeah, we're offshore in the North Sea, and the tax regime's a bit rubbish, but we also own strategic assets onshore in the UK which keep the lights on for people. It changes that conversation.
Yeah, it's going to be important, that one, because when we come to talk about tax and so on, they haven't quite worked out the bit where we've shut down everything and we then need some gas to keep the lights on or the grid going. But can we talk about Norway, please, Andrew? An area you've always and previously said as an attractive place you wanted to invest in. Some people have made it their whole game. Some people have moved out recently. But you've got Balder Future. It's a very big play. It's obviously running a bit late, but you've done the smart move. You've done is to put in the hybrid bond to protect your income and, of course, your outgoing costs. So
yeah,
talk me through Norway.
So basically, Vår, who's the operator of that asset, has now come to the position or announced the position, which is where we always thought it would end up, which is that it won't be on stream until probably Q2 next year. That's why we structured the deal when we bought Mima in the way in which we did, to ensure that we didn't have to pay back the hybrid bonds. So we had effectively a 45 million, not windfall, but a reduction in costs as a consequence of being in that space. I've been out to the vessel in Stavanger. It's coming on. I mean, it's sparkly. I mean, it's I think the total amount they spent on this vessel is something like 60% of the market cap of Carnival cruise liners, and you can only take 35 people on board, and there are no water slides. So it's massively over budget, it's massively over time. But when we bought into this asset, we felt that the night is darkest just before the dawn, and that's been proved right. We then further protected ourselves with the hybrid bond, and I think that was the right thing to have done, or it definitely was the right thing to have done. And the hybrid bond now trades at like 3 to 4 cents on the dollar. So the market has made the assumption that that bond is never going to be paid back, and they're probably right. Systems are now getting completed. Things are happening. There's a hell of a lot of people on site. I mean, when you walk around the site, there's like 700 people on this vessel. I mean, they've got a little small town built next door to it to house everyone. But it's going the right way now. We're glad that it's made our lives easier that Vår have acknowledged the timing, because we were trying to talk to investors and say, this hybrid bond's not going to be paid back. It's going to be next year. And Vår were insisting that we had to maintain the operator's view, and that's what we've done. But now we can be much more open about that, and you can see from their press releases as to what's happening. So all of the wells in the first couple of phases have now been drilled. The risers are in place below the water. The mooring systems are in place. So it's just a question of, once all of the stuff on the vessel has been tested and the system's commissioned, we can sail it away. But it's not, this is Norway, offshore Norway. You do not want to be trying to hook up a vessel in December, January, February. It's going to be after that.
Yeah.
That suits us in the way in which we structured the bond. So we're very positive about that.
So you reckon
there's a lot of upside there as well.
Yeah.
I mean, you spend 4 billion on a vessel and sail it away quickly. I think one of the things that I would note about Norway is I don't think the market is giving us any credit for the 2C position, so the contingent resource position, because it's not been sanctioned, because VOR's not sanctioned it until the vessel's out there. As soon as the vessel's out there, they'll sanction it, and that will significantly improve the uplift the resource position.
So let's just look at that. Second half of next year, it's coming into production. What's it give you? 15,000 barrels a day net, or so?
Yeah, it's not second half. I mean, I think it'll be the end of the first half, to be honest.
All right, yeah. So you'll start and it'll crank up sort of reasonably quickly, but it won't go straight to full production. Obviously, these things don't. But by this time next year, you'll be in possession, of something which economics metrics wise is going to look pretty good to you guys.
Yeah. It'll validate the reason why we did it in the first place.
Yeah. Quick look at GLA, where there's been a change of operator, yeah. And you're prioritizing. I mean, you've always talked about Glendronach. I seem to remember in presentations for years gone by, you've shown me pictures of that potential. That's comes up before Ebrador.
I think it's more like, I think the first one off the blocks now will probably be Glendronach. I mean, Praxim buying it or agreeing to buy it because it's not closed yet. They wouldn't have done that if they weren't going to sanction further activity. So Total were pretty irritated by the UK government's tax approach, and that was affecting their decisions to make decisions, frankly.
Yeah.
But Prax have bought it, the people we know, we've spoken to them many times in the past. The other partners in the asset is another company in the UK, which you may have heard of, called Rockrose. Can't
put a face to it, but
yeah. I think the face is on the screen, to be fair, Mal. And Ineos. And all of us were keen on doing this. The other implication of the change in operatorship is around the decommissioning security postings. So Total were of the view that they didn't want to adopt OEUK guidelines on decommissioning security postings, which meant that we were going to have to post more money. It's been accepted now as part of this transaction that those numbers will come down. So actually, we end up posting less money, requiring less surety, which obviously is good for our balance sheet.
So there'll be 2 or 3, and the Victory approval recently received.
The Victory's going through, and Shell made that decision. And there's also Tornado as well, which is the other one that is going to potentially come through there. But I think
they make an interesting view because of unit costs and things like that. Yeah.
Yeah, it extends the life. I mean, the problem of the whole GLA area and the west of Shetland gas plant is that it's not the well stock producing that's the issue. When it was originally constructed, it was constructed on the expectation of a much higher throughput than it's ended up having over the years, because various things haven't come through. So basically, you've got a big pipe that you need to get a lot of gas down. If you don't get enough gas down that pipe, it basically, the economics they stop working. So the economic cutoff of of the whole GLA area is not driven by the productivity of the wells. It's driven by how much you can continue to run the Shetland gas plant out. Yeah. So things like Victory, things like Tornado, things like Glendronach all help the argument of keeping it open for longer and therefore increasing our economic life in where we stand.
Great. I think that's absolutely clear as crystal now. Quick update on the Netherlands. You talked about Orion in the interims awaiting clarity in the status of extension and so on.
It's not. I think you might be mixing two things up. The clarity in terms of the extension was about M10, M11.
Right.
Orion is going through a feed study right now. The issue with Orion works, but you've got to work out what the export route is, and at the moment the plan is to take it across P15. P15 is an asset again that we knew well because we were partners in it back in Rockrose days. It's TACR operated, and it, you know, we've had from Q10 we've had 100% uptime. From in terms of our ability to get gas to the beach, that has come down to sort of 85 as a consequence of Orion. Sorry, of P15.
Yeah.
I think the change that's happened there, which is a positive change, is one that says TACR have now brought in all the other partners and everyone else, including Dana and Neptune, who put stuff across it. And we all now sit in the same room and share information. And that didn't used to happen. It now happens. And I think that's a very much stronger place to be. And it means that we can have a lot more confidence in the way forward, because it's all on cost share. Yeah. And who's going to put stuff across it, what that means.
Okay.
The production from the asset itself is fine. It's always been an issue with the export route.
Understood. Now financials. After the interims last week, we had a long chat. You were concerned that one or two people on the message boards and in the marketplace had got the wrong end of the stick, probably a better way of putting it. And I've written something as a result of that, which will go out in the next day or two. Regard to your perceived problem, and it's perceived, not actual, with net debts. So if you could tell us what the situation is with regard to the cash, the debt, how the receivables unwind, that probably make life a lot simpler.
I'll look to my notes to my right here to make sure I get this right. Formally, we have to say that it's $175 million of debt with 72 million debt, 72 million of cash. But what you have to bear in mind is we have an $84 million receivable for last year's capex coming in December, the beginning of December of this year.
Right.
And then on top of that, we've already chalked up another $35 to $40 million that will come in December of, well, will come in during 2025. And I'll come back to why it's during 2025 in a second. So really the net debt picture is actually much more like $50 million. And, you know, people have commented on going concern comments in the year-end accounts and whatever. And the irony of that is if we hadn't paid down our Dutch debt at the end of last year and saved shareholders $5-6 million of additional interest and bought the gas storage business, we wouldn't have had that comment in the accounts. And it's very much a UK thing going on at the moment. If you're in the States or even if you're in Norway, you wouldn't have those questions. It's just auditors are scared of their own shadows in the UK at the moment from the results of various things that have gone on over the last couple of years. So I think it's fair to say that we would count the net debt figure as much more like $50 million than 175.
And as you say, next year, because it's you're getting the money back from this year, you're getting money back from the 23 investments. The 24 investments you've made are also tax offsettable, and therefore you will get them next year. But as you just said, that won't come in December in one lump. It'll come maybe as an offset to Boulder or something, or how does it work?
Yeah, it comes as an offset. It basically comes as an offset to your continuous tax payments along the way. Yeah. So you just don't pay tax as a consequence of knowing that you've already got a receivable on the other side. So your free cash flow generation goes up.
Right. So when Boulder comes in, instead of coming up in one lump, you just continue to have a free run.
Yeah.
Right. Nothing else on the
It's a free hit in cricketing terms.
Now you're talking. Okay, I waited long enough to talk about the UK tax situation. I'm not sure how much. I think everyone has calmed down a bit. We're not quite sure what's going to happen next week, or next month, or the end of this month. Your thoughts on the UK tax regime are well known. Perhaps more important, obviously, you mentioned something there, but maybe critical to the future of the North Sea, and therefore you're as an M&A man in particular, with your hat on for that, you're looking outside the UK, presumably for further acquisitions.
Well, let me talk about the UK tax position first, if I may. I think the problem is that it's become a bit of a political football. And, when, as an industry, we had got comfortable in conversations pre the election with Rachel Reeves and the leadership of the Labour Party that nothing was going to change in terms of investment allowance. And, okay, we were at 75% and that was that. Then Ed Miliband had his little spat with Keir Starmer about the 28 billion Green Fund. And that then pushed the Labour Party towards this 78% position, and a lack of clarity in terms of where the investment allowance was going to end up. And I think what we feel now is until we have that clarity, and once we got past the budget, it's very hard to value things with certainly any development assets, with any confidence as to where you stand. And we won't be committing significant capital to anything in the UK sector until that clarity is delivered, and we can look people in the eye and say, this is what we think it's going to look like. So, really, the ball is with the government. Miliband, I think taxing oil and gas companies has sort of become a bit of a victimless crime, and in the eyes of both parties, actually, it's not just the Labour Party, but in the pursuit of 18 to 28-year-old voters, they just said, well, let's just do it. It doesn't matter. But I mean, you and me, Malcy, are old enough to remember things like, when on the radio you would have comments on, balance of payments and money supply and where all that sat every week or 2 weeks. People underestimate we still need these hydrocarbons. If we have to import them, it's not good for the UK economy ultimately.
No, I mean, that's a very valid point. My other valid points, which I've been making more recently, is not just that you're closing down a whole industry in order to make a point about net zero, but also you have a situation whereby in a year or 2 years or 5 years, you will still be needing to fuel the power somehow. The transition to gas won't be continuing very long if the North Sea is shut down, and nor if the onshore is shut down. And it's not just the 220,000 peoples in the unions. And I've just seen the Buchan video, which you've probably seen around about, which I'm putting in the blog in the next day or two. But actually, more importantly, that we will end up, having got the North Sea down to a lowest carbon level I've ever seen, and will be as low as it is in the whole world. And yet, we'll be importing oil and gas from dictators and despots all over the world, and having,
I mean, if you bring it in by
LNG shipped halfway across the world, driven by a carbon-driven boat, and
I did A-level physics, and I'm not an absolute genius in this area, but if you're going to try and refrigerate gas in a company like Qatar and then ship it, a third of the way around the world, it's not necessarily the best place to do it.
Yeah, but it loses 15% on the way back, on the way over. I mean, they lose about 15% of the gas from those LNG tankers. And then, of course, everything that comes into the UK, LNG-wise, goes into one pipe that goes all the way. So talk about national, things going wrong. We talked earlier on about finding, in other countries. So I'm going to South Africa next week, and where they have routine blackouts and so on, and the same thing can happen to us. And anyway, perhaps we should.
To be honest, I don't think we'll end up with blackouts, but we don't improve our carbon position for all of the possible that is associated with that. We certainly don't improve our carbon position, and we become net takers of price as well.
Yeah.
So, a crew on an LNG tanker sailing out of the Med gets routed to the UK because the UK's price is higher than it is in France or Germany or whatever. We just become takers of price, and that's not great.
No.
So I think it is short-sighted. I think it was done for political reasons. I don't see anyone investing right now, and I know I can go out if I wanted to and rent a rig or a floatel or whatever really, really easily at the moment in UK waters because no one else is using them.
Okie doke. Let's just finish off that, all of it almost, because we're running out of time. Where it takes you on M&A, where you've got a highly skilled team of M&A people, looking at things. Obviously, without giving the game away, any thoughts on what you might be looking at, or tell me that you have got things in the pipeline.
Yeah, we do. We're in about 4 processes, I think, at the moment. There are tax reasons why buying production assets in Norway makes sense for us, because it frees up that Norwegian tax credit earlier. But that really only applies if we can get something agreed by the end of the year. Because after that, we don't have the same tax pressures. We're not looking at anything in the UK until we know what the tax clarity position is around that. We are looking at some other jurisdictions, and I don't want to go into too much detail, but suffice to say, we're not looking at Africa right now. Yeah. We did think about it and we decided not to. There are a couple of places in North America and the Caribbean that we're looking at, and we have looked at other stuff as well. We bid on the Tethys process. We think the Chinese paid a pretty big premium for that. I'm sure you're aware of what that.
Yeah.
But we did look at that in Oman, but we just couldn't get our heads around those kind of numbers. We just thought that was just too much money. So, I mean, I think one of the interesting things at the moment is assets are changing hands at pretty high values, and they're not the values that are represented in the Kistos share price.
No.
And we've sat there and gone, should we be buyers or sellers at this point?
Yes.
Closer to, where it stands, because unless the market starts giving us credit, then it's more valuable on the metrics that we're seeing that other people are paying. And if you look at Norway, for instance, people are bidding. They're bidding on 2C as well, and they're paying for 2C as well as 2P, and they're also, they're valuing things at like MPV 7 when most Norwegian bonds are trading at 12 to 14%. So, there's not much financial logic in that, and we've missed out on a couple of things where, frankly, we've bid well, not that we've bid too low, but other people have been prepared to pay more money, and we own too much of this business, Malcy, to blow money away on these things, yeah. And so we're very careful about what we are prepared to pay for things. But you can rest assured that we are looking at stuff every day of the week. I've had 3 BD calls this morning before I've spoken to you.
Well, I'm pleased to hear it, and I know the shareholders know that the most directors and owners owned share in the market is you guys, so know exactly what you just said, doing it in interest of making money for the shareholders, and the shares are too cheap. I'm sure that will change. We've got to get through the budgetary situation in the UK first,
but remember that, unlike, I don't know, Serica, Enquest, whatever, these guys are much more exposed to the UK as a proportion of their business than we are. And it's not criticizing them at all. It's just an observation that, we are less exposed to the UK. Most of our future upside is actually on the existing portfolio is in Norway.
Yeah. Okie doke. Anything else to add? How you see the company over the next 12 to 18 months? You've pretty much gone through it, but I
think I've gone through that. I think,
yeah.
I don't think the market gives us credit for the gas storage business. I don't think they understand it. And as time goes by and they start seeing the returns out of that, while they're not stellar in the sense of upstream returns, they are solid, and it's a really, really good asset, and it has a long future. I think Norway will be easier for people to understand once it's on stream, and as I say, I expect that to be Q2 of 2025. And I think when that happens, people will look at it and go, do you know what, that was a bloody good deal. Buying that for 0 was smart, and it'll give us the ability, if we choose to refinance it at lower rates, and be in a much stronger position. GLA, in new ownership, you're going to see projects being pushed forwards. In the Netherlands, you've got a higher spirit of cooperation, and I think those are probably the main messages I'd want to leave with people.
Great. Well, thank you very much indeed, Andrew. It's been fantastic to talk to you again. Been too long.
Always a pleasure, Malcy. Thank you very much indeed. Take care.
Let's not leave it too long this time. And
no, I won't. Look, I've got to have something to talk about, and
Yeah, quite right. I've been Graham Wood and been doing the C-suite interview today, where my guest has been Andrew Austin, Executive Chairman of Kistos. Thanks very much, Andrew, and thank you very much for watching. Look forward to seeing you next time. Thanks very much. Goodbye.